Hi, IBD. I'm Meredith Heyman. This is Industry Insights. Thanks so much for joining me. The Federal Reserve's decisions on interest rates impact both the economy and the stock market, but how each reacts can be very different. So, what do investors need to know? Joining me with some historical perspective on these decisions is IBD editor and economy expert Ed Carson.
Well, I'm sure I'll live up to all that. Thank you so much.
I am very confident.
Well, thank you.
Absolutely. So take me back as we look into the potential of interest rates cuts. Historically, what happens to the economy and the market when rates have been cut or not have been cut?
Obviously, it depends greatly to what kind of situation the Fed is going in with the economy is. When the economy is about to head into a recession, like 2008, when we went into the great financial crisis, the Fed was cutting rates, and the market did not take off. Because the economy was collapsing. But there's different situations. Like a lot of people are trying to use an example of the mid '90s when the Fed sort of proactively first raised rates, but then they, just to cool off and really snuff out inflation in a way that we hadn't really seen even in the '80s. And then they started cutting rates, but because the economy was still doing well, then the market really took off. And so if the economy is in decent shape, those rate cuts are a real tailwind because those rates are a negative for stocks. And so you just remove that. It's just like you're shifting into a higher gear. Saw that in the mid late '90s, stock market really took off. It also helped. We had the dot-com revolution. We have the AI revolution now. So that's a possibility. That's something that if the economy is in good shape and the market and the Fed decides to cut rates, it can be a very powerful tailwind. And obviously, we've already gotten some movement in the market in anticipation of that.
So, what's the difference between how and when the economy reacts to these decisions over interest rates with versus how the market reacts and responds?
Well, it takes months for this to filter through the economy. I mean, that's one thing. It's a little bit like turning a cruise ship. That's part of the reason why it's so hard for the Fed to adjust rates. You have to do it in advance and not know what's going to happen, before it has an impact. Because yeah, you raise rates, it filters to the mortgage rates, and then well down the road, it affects several months down the road. Those are like you start seeing the decisions, and that affects furniture sales, and it affects builders' future decisions. And that's just like in housing. You can see how it takes months for that to happen or corporations, they have cheap debt, but over time they have to, their debt becomes more expensive. But see, like this is over, it takes quite a while for that to really filter through. Stock market, boom. I mean, when the Fed announces a decision, especially if it's a surprise, the market goes up or down quite a bit immediately. Partly because the treasury yields will move immediately, and so yeah, it's real instantaneous. And lately, the Fed has been almost leveraging that a little bit. They've been paying more attention to what stock prices have been like, uh, and to trying and using that to charter monetary policy.
So, what happens? Let's look specifically at the market when interest rates rise.
When the interest rate rises, you're going to see treasury yields rise usually as well. Now, again, it's going to be more towards the short end usually because the Fed funds rate is an overnight rate. So you're going to see the bigger impact usually on the shorter term rates like the T-bills or maybe the 2-year rate, which is closely aligned with the Fed rate outlook. Well, what do you expect rates to be in a year or two? The 10-year yield is more about the economy. So then there's that. So it'll move. You'll definitely see it move, but it's more about, well, how do I think the Fed policy is going to affect the economy longer term? And all that will filter in the stock market. The stock market, they will take a look at this and they see like, well, if it's going to be growth stocks, they might, get a boost or a hit from higher rates because the market tends to discount future growth. And so if a lot of the valuation of a stock is based on future growth, then higher rates are going to make that seem less attractive relatively. And you're going to see interest rate sensitive sectors rise or fall. And depending on how that goes, some of them benefit, some of them don't. I mean, home builders, a lot of financials will move on those rate moves in particular.
Yeah, Ed, and what about when interest rates fall?
Oh, absolutely. It's the other way around. You get
Right.
lower interest rates, then all of a sudden the growth stocks look more attractive. It also like home builders, lower mortgage rates, and there's just a general sense that The alternatives, I can put my money right now in an online bank and get 5% or close to it, or put in a treasuries and get a little over 5% on short-term yields. How much do I want to risk? But if those yields come down to 3%, I'm at the margin more willing to say I'd rather bet on the stock market. So lower yields, lower rates do, on all things being equal, are a boost to the stock market. Obviously, if the economy is tanking and there's all this kind of crisis, it's just it's just one little factor in all these other things. But if the economy is doing okay and then you cut rates, boy, that can be a really nice boost to all those things, to the market and to those specific sectors that are especially rate sensitive.
Absolutely. And so, how can investors prepare? What should they know? These interest rate hikes or cuts, they can really impact the psychology of investors, right?
Oh, absolutely. And I think what you have to think about, I sort of think of like Fed meetings as like an earnings report for the market, kind of thing, is that you can just on a dime because it's hard to know how it's going to go. And sometimes you can know, oh, the Fed might say this or that, and the market will turn around and do something different. And even not just that day, but the next day. And so just when you're heading into a Fed meeting, just, well, how aggressive do you want to be? Knowing that there might be a fairly rapid move, and it might be positive, it might be great, but it's like an earnings report. You just don't know. You might think you know, but you don't know. So I think that's something important. Just knowing that this is, again, there's certain periods when the Fed isn't going to do anything and nobody cares. Okay. I mean, honestly, in Fed meetings, hardly anybody's paying attention. But, whenever the Fed is at turns and it's like and there's surprises, you really do want to be paying attention because it is this earnings report for the market. Everything might move very quickly and you just have to be prepared for that. Is your portfolio ready for that? If it takes, if you're really, if there's a big drop and maybe drops in the days and weeks beyond that, can your portfolio take that hit? So it's just something to think about coming into those big names.
Absolutely, Ed. Well, we'll be watching. Thanks so much for joining me.
And thank you very much for having me again.
Absolutely. This is Industry Insights. Stay right here on IBD for more. I'm Meredith Heyman. Thanks for watching.